Okay, this is episode 4 in the 11-part series on the hard landing. This one we're going to be talking about the yield curve. And the yield curve is, like what I said in the previous video, really what got me into macroeconomics, is that what you're about to see is going to blow your mind and say, wow, I mean, what is going on out there? There's definitely going to be a recession. How can there not be? So let's kind of get into it. So, I've showed this in almost every video prior. Go watch the business cycle. Go watch all the previous videos if you haven't yet, where I explain all of this. But I want to focus on this area right here. Is the government issues IOUs or treasury bonds to borrow money from the economy. And they do this at different durations. And, I talked about the different durations in the business cycle, but I just want to touch on it one more time. And this is it, from above a 10-year loan, they're called treasury bonds. And anything greater than a year to 10 years are called notes. 1 month to 1 year are T-bills. So, if I'm loaning my money to the government, I can pick any of these. I can buy any of these, and I'll get a different rate depending on that duration. Okay, so I give my money to the government, and they pay me after 3 years. They'll pay me back what I gave them plus 1%, yearly interest on that. And the Fed funds rate is the overnight rate that the Federal Reserve controls and moves. Okay, so this is a normal looking yield curve. Okay, this makes total sense. If I'm going to lend my money to the government for 30 years, I want a way better interest rate than if I do it for 1 month. Okay, you'll typically see this type of curve. Okay, this is a normal economy. Everything makes sense. The Fed funds rate might not be at zero. It might be a little bit higher, but generally this is the slope. Okay, what do we look like now? This. Okay, this is completely opposite, and you might scratch your head at this and be like, what? I know. So this is the the yield curve on July 12th. I took this screenshot a couple days ago. But why does this happen? Okay, I'll tell you right now. The Fed funds rate, say it was way down here. Well, prior, during COVID, I think it was right above 0%. I mean, right above zero. So this was way down low. It was right here. And then they rapidly rose the Fed funds rate. So they drove this up. Okay? And when they drove that up, it basically caused the short end of the curve, they call it, these short durations, to be higher than the long durations. Okay? And you might say, okay, well, why don't the long durations rise too above the short duration? Why do they kind of stay, limp down here? Well, think about it. The only reason these would be lower is if you think that the interest rate, let's just pick this 10-year, this interest rate of 4.2% is greater than the average over the next 10 years. Because if you buy this at 4.2, you're thinking, okay, this will probably come back down, but I'll still have that 10-year rate that I bought it at. So this is kind of an expectation that rates will come, short-term rates will come back down in the future. Okay? And these long-term rates are a direct prediction of future growth and inflation. Okay? Because if we thought that we'd have future high inflation, this 10-year would be higher, because you want a higher return on the money you're lending to the government over 10 years if you think there's going to be higher inflation. Okay? It's like, yeah, I'll give you my money, but I want a higher interest rate because my purchasing power is going to go down from inflation. But that's not what we're seeing. We're seeing that it's lower than the short-term rates, showing that people's expectations of inflation, and growth are lower than what they are at this exact moment. And it's also growth because when there's a high growth, stocks and riskier assets go up a lot more. So if they see future growth, they're gonna charge a higher rate because you have that opportunity cost where it's like, oh, well, I could invest in stocks in the future, but I'll invest with you, you the government, if you pay me a higher rate. That's not the case. They're expecting lower growth, at least lower growth than they are short term. So this is a normal yield curve, and this is an inverted yield curve. Okay, we have an inverted yield curve right now. This is just crazy because you get paid a higher rate to lend your money to the government for 1 month, on a yearly basis, than you do for 30 years. Just think about that. You'd say, who in the right mind would lend money to the government for 30 years if they can do it for 1 month? Well, a lot of people, okay? Because a lot of people are buying these. And the more people that buy these, the lower the rate goes, okay? So that's essentially what we're looking at, okay? And this is the Fed funds rate, and this kind of shows why that short end of the curve went up so fast is when the Federal Reserve rose those short-term interest rates, the Fed funds rate, they rose it super, super fast, okay? I mean, it skyrocketed up. And if you just look at this trend, ever since 1980, we've been on a downfall, okay? And we kind of went flat, and now we're kind of going back up. And this is kind of why people say, higher rates for longer, because this is a direct, this shows you the long-term debt cycle, essentially. And people think, oh, we're entering a sea change. We're going back up. But this put a huge strain on the economy. This, higher rates means less credit, less spending. But they're trying to fight inflation. So that's kind of where we're at. So this is a zoomed in screenshot of that Fed funds rate going back 25 years. And I just want to show you the difference in charts between the Fed funds and the 2-year note and the 10-year note, okay? Because the 10-2 yield curve, they call it, is very important. So this is the 2-year note, okay? And if you look at this, it's pretty wild. The orange, the 2-year, always precedes the Fed funds, okay? It's almost like if you shifted the orange to the right, it would just nicely overlap with the blue line, okay? And so you can kind of predict what the Fed funds is going to do by just looking at the 2-year, okay? And you can see that the 2-year is pretty correlated with the Fed funds, right? It typically goes in the same direction right there with it. And this shows that the shorter duration, or at least the closer to the Fed funds rate you are in duration, the more correlated you are with it. Okay, so let me go back to here. The closer you are to this Fed funds, the closer related you are to it in the chart. And then the farther you go out, the less correlated you are. And we'll see that right here. This is the 10-year. See how the 10-year kind of has a mind of its own? And this is because the 10-year, a lot can happen in 10 years. And this is kind of a direct outlook on what's going to happen over the next 10 years. Whereas the orange is just a reflection over the next 2 years. So it's a lot closer with what goes on with the Fed funds. Okay, now this is really important because this is the 10-2 yield curve. Okay, so if we go back, this is the 10 minus the 2, the difference. Okay, so in a normal yield curve, you'd expect the 10-year rate to be higher than the 2-year rate, right? So that would be a positive number. And that's typically what you see. The 10 minus the 2 is a positive number. But when that 2-year rate goes up and goes above the 10-year rate, you get an inversion of this yield curve. Okay, and we can look at this right on the chart. And let's pick one. Let's do 2008. Okay, 2008. You see the so we're looking at the orange and the purple, and right here, the orange goes above the purple. Okay, and well, let's look at it now. Right here, the orange skyrocketed above the purple. Okay, and this is the inversion, because then the 10 minus the 2 is negative. And this is where we've been at. The 2-year has been higher than the 10-year for this whole time. And this is shown right here. This is an inverted yield curve, okay? And this, I should have shown it here. This is a phenomenon that happens before almost every recession in the last 50 years. You can see a dip below, you got an inverted yield curve, and then you uninvert, recession. You dip below, uninvert, recession. Dip below, uninvert, recession. You did dip below here, you can't see it, but you uninvert, recession. Look at how long we've been inverted. I mean, this is a crazy inversion. Going back to 1980, this was wild because they were raising interest rates really high, dropping them, raising them high. So this got kind of out of whack. But I mean, just look at this. You can clearly see that there's a pattern. Okay? Now let's talk about why it uninverts before the recession. And this is because the Federal Reserve will drop the interest rates prior to a recession. Okay, the Federal Reserve knows a lot. And they know things are getting bad kind of before everybody else. So they'll start to drop the rates, and then you'll get the recession. And when they drop the rates, the 2-year then goes below the 10-year, and then you go back positive, okay, because it's 10 minus 2. So when they drop the rates, you go positive, recession, okay? Drop the rates, recession. Drop the rates, recession. I should have said the red is the federal funds rate. Drop the rates, recession. We've gone up. We've been steady. We've held them. The longer he holds them, the worse this recession is going to be. It's just putting so much strain on the economy. But if we look at history, they dropped it here. If we look at history, right when he starts to drop those, we're probably going to have the recession. If you just look at history, okay. And then what you really should look at is the uninversion of the yield curve, okay. And that'll probably happen right after he starts dropping the rates. We're inverted. Right when he uninverts, that's when you really gotta look out for it. And this is just one form of the yield curve. There's also the 30-year minus the 2-year, and there's there's the 3-month and the 10-year, I think. But the 30-year and the 2-year actually just uninverted yesterday. Okay, that's not as a big deal as the 10-2 yield curve. But, it goes 32, and then it goes to the 10-2, and then it goes to the 10-3 month. So, we've already started. Now, I just want to touch on one thing. We've only had 2 soft landings in the last 50 years. And a soft landing is where we avoid a recession. And this only happened in the mid-90s and the mid-80s. Okay? And notice something about this. They started to raise rates to slow down the economy. But they stopped raising them prior to the inversion of the yield curve. Right? They rose them, but then they stopped before it inverted. Okay? And then they brought them down. And that's the only 2 times they've had a soft landing. The Federal Reserve is always behind the curve, they call it. They're always late to do stuff. They were late to raise interest rates, and now they're going to be late to drop them. Okay? They started to raise rates. It inverted it immediately. Okay? And it's been inverted for forever. I mean, I think this is the longest inversion ever. It actually is. I just saw an article about it. The longest inversion ever. So, keep track of this. Once the Fed funds starts to drop, the 2-year will drop before it, and it'll uninvert the curve. And if you ever want to have an idea of what the Fed funds is going to do, just take a look at the 2-year. Okay, the 2-year always is in front of what the Fed funds does. See, it raises before. So that's the yield curve, and it's a pretty crazy phenomenon that you can get paid more on a yearly basis for lending for 1 month than you can for 30 years. In the next video, we'll talk about businesses and what the higher interest rates, what they've done to these businesses, putting them at so much strain, and we'll just keep going down the list. It's kind of a domino effect of what happens and why and what it causes. Okay, and we'll talk about businesses next. So till next time, Godspeed.